Looking at this rally that we've had so far this year, do you think that whatever tailwinds caused that rally will persist into the second half of the year?
Romaine, I hate to be so sobering on a Friday, but probably not. And for some of the reasons that you've opened the show with today, the economic situation is likely to slow. Certainly overseas, Europe's already slowing. UK has a terrible inflation problem, is doing its best to contain it. And as for the US, I mean, even more inverted yield curve, plus the fastest Fed funds rate rise up to 5 percentage points that we've seen in I don't know how long. What's going on in credit and tightening of credit? I mean, there are numerous reasons why the stock market in the U.S. and overseas may have gotten ahead of themselves. It doesn't mean to say there aren't stocks to own.
Right.
It's just the broad indices might have have a bit of a setback ahead.
Well, I am curious, Chris, about that here, because remember, this was kind of the discussion heading into this year. That was the surprise that those worst case scenarios didn't materialize. But we started to see a lot of softness in the economic data. We got global PMIs this week that showed that Europe's still in deep contraction, at least in the manufacturing sector. And the U.S. side isn't doing much better either.
But Romaine, despite all that bad news, European stocks are near their all-time high. U.S. stocks are near their all-time high. Look, my fiscal year end is June 30, so I am getting right to the finish line. I just want to keep going at least another week before, as Sarah said, kind of the reality sets into this market. Romaine, we have been predicting a recession since almost last summer. And yet here we are again. I'm going to tell you, there's likely a recession somewhere in the next 2 quarters. Yet this market defies gravity and keeps climbing. So this last week was a rough week. Mm-hmm. But hey, after such a run for 5 weeks, it's got to stop and catch its breath. The question, I think, as Sarah is saying, what is the future? It's about earnings. And there's a lot of headwinds that would say we should slow.
Well, Chris, let's talk about earnings here. We're about 3 weeks or so before we get the start of the fresh earnings season. And there is concern here that maybe some of the resiliency we saw over the last couple of quarters, the quarterly reporting seasons, that might not necessarily hold up when we get the results in mid-July and through August.
Romaine, I was surprised at that resiliency, but it came from this, the incredible stimulus during COVID, and it has hung on for a whole year, kind of beyond COVID. I mean, it's still with us, but the reality is we have been all shocked at how strong the consumer is, the employment numbers, the fact that, jobless claims was flat and steady this time is maybe a sign that we're going to start to see a buildup of unemployment. Mm-hmm. I've got to listen to Powell, what is said during his testimony, that he's willing to sacrifice employment and economic growth to kill inflation.
Well, Sarah, what does that mean, though, for investment allocation? We know, at least in the equity space, particularly here in the U.S., tech stocks, and particularly we talk about software and semiconductors, really led this rally here. Is there a case to be made to be exposed to other sectors?
There is probably more defensive. We've added a considerable amount of consumer staples as a place to get both income and stability. Those low beta stocks could be very useful in the next 6 months plus. It's hard to predict timing, but I'm on the same page as Chris. I'd add to that is it's not just earnings, there's liquidity too. And liquidity should be draining out of the monetary system globally, with the exception of China. So the Fed is going to take $1 trillion off its balance sheet, supposedly every year for the next couple of years. That's a tremendous headwind. So being a little more defensive, and not to mention the cyclical stocks, as Chris mentioned, have really run. I mean, why have materials and industrials and financials done so well before the recession? It's really extraordinary.
Is that based on, do you think people are buying into the idea of the economic cycle, or is there something different driving that, Sarah?
I just think they're, nobody wants to get left behind. And clearly the big winners year to date have been information technology, communication services, but some of these cyclical areas outside of energy, which was last year's winner, which has been pretty soggy this year, the rest have done surprisingly well. And maybe it's just a disbelief that there will be a recession.
It will be a recession. And Chris, we have to point out, too, when we talk about the rally that we've seen in equities, this has been truly, indeed, been a global rally. You mentioned, of course, Europe, equity indices camped out near record highs. We, of course, knew last week the Nikkei over in Japan hit a record high. And while U.S. stocks aren't quite knit back to their record highs, it's still been an impressive turnaround from where we were even just, I don't know, 6 or 7 months ago.
Romaine, it's been weird. And I mean, you know, in the technical CFA sense, complex idea, it's weird. Seriously, a global rally, when you said that, you know, you're getting weak industrial numbers out of Europe. And on top of that, what a narrow market. I mean, for up until 2 weeks ago, it was 9 stocks. I don't know, Sarah, as an active manager, how you make money in a year where it is so narrow and the breadth in the market is so bad. Over 500 or 250 of the S&P 500 stocks are actually down on the year so far here in 2023. So, Romaine, like you know, we own the market, so and we're global. So we've capitalized on the fact that Europe and Japan have done so well, and the U.S. has done so well. But I'm leaning defensive as we get into July and across the summer.